start off with approval of each of the pension committees, given that I think we've got everybody from fire here. So let's start off with first of all, Cheryl, you're keeping note of who's attending, right?
Yes.
Okay, and so let's start off with the Fire Benefit Committee agenda. So we'll approve the minutes of the May 20th meeting. I'm asking for a motion to approve.
I'll give that.
All right, Paul, second.
I'll second it.
Okay.
I'm sorry, who is that seconded?
Joe.
Okay. Thank you.
Okay, any additions or changes? Okay, as for a motion to approve, just raise your hand.
Oh, there we go.
I guess it's unanimous. Bill, you're good with the minutes?
Yes.
Okay. All right. So let's start then. We'll start with the quarterly financial review and ask Michael to cover that. And that really, you do that for pretty much all of the capital markets, and then we'll go specifically to the fire.
Great. Well, thank you. Good morning, all. We certainly know that it's quite a change it's been since we last convened. The S&P 500 as of yesterday actually closed at its pre-coronavirus high, which essentially means that at least if you're an index investor, you have you've recovered all the losses that we saw in March. The Dow is still down a little bit for the year. The Nasdaq's up dramatically for the year, as a lot of the tech names have really been beneficiaries of the stay-at-home orders and the like. We are the economy and kind of all of our worlds. I hesitate to say we're getting back to normal, but we are adapting, I think, and I think that's really the important point. We're seeing, for instance, some of the economic numbers, although very, very ugly, have been coming in a little bit better than expected. Same is true for unemployment numbers. It's tough to get excited when you have an 11.1% unemployment number, but when the expectation is for 12%, 11.1, makes people a little bit happier. And in general, our feeling is we're kind of dealing with what's being termed the 90% economy, if you will, and that is a lot of things are again, I hesitate to say getting back to normal, but folks are adapting, businesses are adapting, and the like, with of course the notable exception of travel, leisure, entertainment, and that sort of thing, which has been and will likely continue to struggle for the foreseeable future. Our government, despite what's going on with the second round of or the latest round of stimulus, having the talks having stalled, the Federal Reserve continues to kind of throw everything in the kitchen sink at the economy under the kind of the premise that now is not the time to kind of worry about what we're going to do in the future. It's about keeping things going right now. And although maybe kind of shocking and eye-opening to see the kind of spending, the kind of debt that's being issued, it's kind of like a wartime footing of sorts, in that it's spend the money now and worry about how to pay for it later. And in some ways that may sound a little bit frivolous, but at the end of the day, it's not a question of whether the money is going to be spent. It's a question of in what form it's going to be spent. And ultimately the Fed, and until more recently the Congress and the Senate and the White House have been very very productive and reactive in what they provided to the economy. The Fed has continued to say, and we know rates are going to stay lower for longer. We have seen some normalization in the fixed income markets as kind of bond yields have stayed very, very low. However, spread product, because of the liquidity the Fed has injected into the system, basically corporate bonds have really recovered, and the Fed has really achieved its goal of maintaining a liquid bond market that where transactions can be affected with some degree of normalcy. So all in all, I haven't touched on the elections. I think I'm going to spare you all the grim, gory details because everyone's got insight and opinion and thoughts about the election. But I think in general we can say that although there will be volatility certainly leading up to it, both candidates of the market should be reasonably comfortable with. Trump, love him or hate him, the fact is he is market friendly and growth oriented. And although Joseph Biden may be a little bit less so and certainly a little bit more left of center, the fact is that he's for the most part a centrist, as is Kamala Harris. And so the market, takes some comfort from that, in that we're not going to, regardless of who wins the election, they're not going to be particularly hostile to the markets and the economy. You may have all seen, just one last parting thought. If you haven't had a chance to read it, I would suggest reading the piece that we had sent out about a week or so ago that talks about the election in a little more detail, and in particular offers some historical data and perspective, in particular on how markets and economies have performed under regimes where taxes have been going up. Because I think, the general consensus is if Joseph Biden is elected, that taxes will migrate back north, but not punitively so, as some of the proposals that had been put out there by some of the more progressive candidates earlier in the campaign season. So big picture, I think we are, we're reasonably optimistic in that the economic recovery from COVID is kind of moving forward, and that by and large our leadership, there'll be plenty of time for Monday morning quarterback, but by and large our leadership, particularly at the Federal Reserve, has really done a good job keeping the economy rolling and keeping liquidity in the system. And really the challenge that we see going forward is going to be not unlike what we saw coming out of the financial crisis. And that is that, there's a high likelihood the economy in and of itself will continue to move along and recover. But there are going to be certain sectors of it that will really suffer, in which the recovery will be much slower. So that I'll pause for any questions. Jim, you're mute.
Yeah, no, I just unmuted.
Okay.
I don't have any questions. Does anybody have any questions for Michael at this point? Okay. Since we don't, why don't we just go right into the review of the fire plan, Michael?
Hey, can you hang on a minute? I was muted, I forgot. Michael, nobody wants to talk about it, but let's talk about the chance of civil unrest.
Mm-hmm.
Have you factored any of that in, or anyone thought about it?
We've certainly thought about it. It's one of those potential outliers. I wasn't alive in the late 1960s, so I don't have any real points of comparison. Although, based on some of the reading I've done, there are some correlations being drawn. Honestly, it's really tough to tell. That is potentially one of the outliers out there, and I think it's certainly been exacerbated by the pandemic. Ultimately, what comes of it, who knows? I think it's one of those unknowns, and I really other than to say it's something that we need to be aware of, it's something that we need to kind of continue to monitor. I'm not ready to make any predictions as to what impact civil unrest, may or may not have on the economy. Thus far, not significant. But other than to say it's really something that we are and continue to keep an eye on, but we're not recommending any action at this point, just for the simple reason that it's really impossible to predict.
How about a vaccine and participation in a vaccine if it's successful?
Yeah, I mean that's obviously the big game changer, if you will, is if we get a viable treatment or a vaccine. Kind of the consensus, if you will, amongst folks in the know or amongst folks that are a whole lot brighter than I am when it comes to this sort of thing, is that late this year or early next year there should be something viable. Ultimately we'll have to wait and see. We know that they're gearing up to rapidly produce something when they finally come up with it. The government, I think right now, is paying, about 30 or so firms basically to produce product in these precursors to vaccines, knowing that the vast majority of it will be thrown out, but under the premise that they want to, once something is finally found to be viable, they want to get it into production as soon as possible. So that is obviously the game changer. We're optimistic, but I'd be lying to you if I said I know anything more than what's being reported and what we're reading and hearing from talking to folks.
Okay, thank you.
Okay. So with that, we'll turn it over to Claire. Just so happens that the fire plan is first in the report this quarter. So just bear with me a moment and I will go to screen share and bring that up for you.
While Michael's pulling that up, I think part of the increase that we've seen in the markets over the past few months, especially more recently, is because they're factoring in that there will be a viable vaccine. And if it turns out that the vaccine is not as viable or as wide-ranging or has the impact that a lot of people are expecting, I think the markets will move downwards, because I think that's part of the reason we've seen the increase.
I think it's important to remember, as we're seeing with Notre Dame and Michigan State and Chapel Hill, starting on in-person learning and then stopping it. To a certain extent, it's a matter of perspective, especially now that we're seeing the vast majority of new cases are coming from the lower risk population, and it's. I read a piece a couple of days ago, which I found to be really fascinating, and that is that the mortality in the United States from infectious diseases over the past century has declined by 95%. And if you kind of think about that, think of mumps, measles, polio, German measles, scarlet fever. It's the list goes on and on of things that were just a normal part of life not all that long ago, quite frankly. And so, that's not to minimize the impact of coronavirus, and certainly to minimize the impact on people that have gotten it. But it's also to a certain extent a matter of perspective, because statistically, this is kind of a blip. And if coronavirus happened 100 years ago, it would get a paragraph or maybe a page in Encyclopedia Britannica. But happening in 2020, it's kind of changing all of our lives, and it's interesting historical perspective, if nothing else.
Even though I had said I didn't have any questions, but given that Claire brought it up with the efficacy of any vaccine and if it proves out or not, but a lot of this has also to do with employment. And what's the projection for the unemployment rate or the employment rate going over the next couple of quarters?
I think, in general, and forgive me, I'm just going to log into my other computer here because I have some interesting statistics I'll share with you. But, big picture, we're seeing for the most part, or no, I shouldn't say for the most part, but in a lot of cases, people are working, either working from home or getting back to work. And this gets kind of almost comes full circle to Joe's question about civil unrest and what have you, it's really, kind of going to be a case of a have and have not sort of recovery, I think, not unlike what we saw coming out of 2008. Everyone on this call is fortunate enough to, be in a position where coronavirus is, for the most part, just an inconvenience. It hasn't had a dramatic impact on our livelihoods and what have you, whereas there's other folks that, have been absolutely decimated by it. And I think, people in those industries, when I mentioned the 90% economy a few moments ago, that's really what we're looking at is how much will hospitality and tourism and hotel and restaurant, or how quickly will it recover, to what extent, and in folks that are employed in those industries, how effective are we going to be at finding them other sources of employment? So that's, I don't have any predictions for unemployment numbers, except to say that, we've seen the numbers come down. They spiked up very dramatically, then they came back down dramatically more quickly than ultimately expected. But the easy work is sort of behind us, and now it's kind of chipping away at the remainder in sectors of the economy that, quite frankly, are going to be slower to come back.
Okay, thank you. Okay, Claire.
Thank you. Lisa, can you turn to page 7, please? We'll do our usual. We'll start off with our 30,000-foot view, looking back to the numbers and cash flows since inception, and then we will sort of drill down on the individual managers.
So Claire, also, when you do these, I know you'll always do this, but it'll be interesting to know what the current, August 19 data, or whatever your latest data is, looks like, since there's been gains since the end of June.
Yes, actually, in 3 minutes time, I'll have your current volume.
Unfortunately, I only have one screen, so I can only share one page at a time, but that is, that's in the queue.
Good, all right, good, thank you.
Hey.
We only go to that page. Okay, so starting off here, we're going to look at our return since inception. So we're up in that top right-hand corner, the annualized return. And so we're looking back to February of 2014 was our start date, and our return since then is 5.4%. So, we've eked out a gain against our policy benchmark. Had we indexed everything, we would have been at 5.1%. Backing down, our beta is a measure of volatility. The market has a beta of 1. So we're a smidge under. So we attaining that return, we took 1% less risk since the period of inception. Maybe a little bit more interestingly, or the numbers aren't terribly wide, the upside and downside deviation. So on the upside, we have 4.93 versus 4.92. So this is good. We've actually fully participated in the positive markets. But maybe even better, when the markets have been on the downside, there has been some protection. You see that 7.84 versus 8.11. So that this is pretty awesome. We're fully participating, but protecting on the downside. So good numbers. And that all comes together, although this number is called the alpha. The alpha says for the risk that you take, there's an expectation of return. So not surprising that if you're taking a heck of a lot of risk, you better give me a really good return for it. And so you want to be in positive territory, because that says for the risk taken, there was value added. The return was ahead of expectation. Now, 0.03, it's pretty small. However, the alpha is never a large number. I mean, if you get to 0.3 or 4, that's doing pretty darn good. So we're on the right side of the tracks here. It'd be good to get a larger number, but it's positive, and that's good. And looking at our cash flow at the bottom of the page, we started off with 0 back in 2014. We're going to ignore the contributions and withdrawals, because every time we have a rebalancing, the numbers get bulked up on both sides there. So what we'll focus on is the net cash flow. Over those years, just over $1 million has come into the Fireman's Benefit Plan. And then the plan has also grown by $467,000 through through unrealized and realized gains, plus interest and income. So we closed the first half of the year with just under $1.5 million. Now, Michael was talking about, we had a great second quarter, and that those solid returns have sort of continued into April and to August, July and August. And we, as of yesterday, our market value had actually increased to $1,570,568. So there was withdrawals of about 11,000. We've gained about $91,000 since that time frame. So we're up about 6% since the end of June. So that's good to see. I'm going to hand this over to Michael just for a wee bit.
We'll pivot back to performance in a moment, but just since the question was asked, this is the value as of the close yesterday. Thanks to Candace, she was up to the wee hours of the morning putting this together. So these are values. Actually, they're 100% current since the market hasn't opened yet. But you can see, 1,570,000. And bear with me just one moment, and I'll get. Just one moment, and I haven't.
The extra wrinkles around my eyes, squinting.
Let's see.
Looks like your mouse is gone, right?
Okay, so can everyone see this? The spreadsheet. So we had, I know the type's probably pretty small. 0 contributions, $10,000 in withdrawals, so net cash flow minus $10,000, $91,000 in earnings, so a total increase of $80,000, bringing us from 630 at 1,490 up to 1,570 today. Ticking back, we're going a little bit out of order, but that's okay. We are going to be recommending that you rebalance the all 3 plans today, but starting with the fire. You're within the 5% variance that we normally use of stocks to bonds. You can see the target is 60% in stocks. You're currently 63.1% in stocks. However, we are a little bit light on cash. Cash, you can see a 1.7% versus a 3% target. So we need to raise some cash anyway. And our feeling is that, especially although things are looking pretty good, just to bring it all full circle, the market is back at a high, and we have the elections coming up in less than 2.5 months. So there will likely be volatility. So, our feeling is prudence is the order of the day. And even though you're within the policy limits, let's take some of those gains in equities and rebalance the portfolio back to target.
Okay, would you like a vote on that now? Approval for that?
Sure, unless you'd like to go back and do performance, whatever the board prefers.
Well, why don't you finish performance, and then at the end of your review, then we can do the vote.
Okay, great. So let's see. Okay, so here we are back to the fire performance through June 30.
Okay. So if we look, let's start our overall asset allocation. As Michael mentioned, we're pretty much on target. So we're 60% equities, 40% fixed income, and sort of as a by the way, we're indexing over a third of the portfolio, and this is obviously on the equity side. Looking at the returns, it's in really pretty nice shape. It was a great second quarter. See, we were up at 12.7%. So, slightly lagging our index, but, we're not going to be expecting to have such fabulous returns for every quarter, but we'll definitely take this one and take it to the bank. So it was a very strong quarter. We had such a significant rebound. But I think it's fair to say, definitely focused in certain parts of the market. As we've all been sitting at home, I'm sure we've all been doing much more ordering online. We've certainly been using our internet services, our web-based strategies, our conference calls. So the technology companies have definitely been the beneficiaries. And as we were mentioning earlier, there are some parts of the market that are very hard hit, retail, hotels and lodging, although that one's sort of bifurcated. So where you were invested definitely had a big impact. But obviously that 12.7% return was very beneficial. And as we look across the other timeframes, we're actually ahead of our benchmark for each of those timeframes. Year to date, so for the first 6 months of the year, we are in negative territory, but it's good to see that we were talking about that downside protection earlier on. That certainly did come through. As you can see, we're down 3.3%, which obviously we don't like to see. But had we indexed the whole portfolio, we would have been down about 4.2%. So we actually, in that first quarter, the portfolio did relatively better than the market when we had that dreadful first quarter. And obviously our fiscal year to date and our 1 year number are the same. That was at 2.8%. And then we moved to the 3 and 5 years, also showing some nice outperformance across those timeframes too. So that's good. I didn't pull in my updated sheet. I didn't put Fidelity large cap growth in, but this is where the focus of the market has been, and that was the reason that we wanted to do that tactical rebalance, which took place after we had our meeting last quarter. And so in the very beginning of June, we added this large cap growth portfolio. Now we didn't get quite that full benefit for the month of June. June was a little bit of a rocky month, but we certainly have benefited from having that there in July and August. And just as a by the way, the S&P 500 year to date is up 20% now. So a huge big turnaround. We see that in -3 and now it's being turned around, it's up 20. It's quite incredible.
Michael and Claire, it looks like we've got about $3.5 million now in Fidelity large cap growth. Could you give us a little background, a little color on that one?
$500,000 where?
Well, between all three funds.
Oh, yeah, sure. Okay. Really, the Fidelity large cap growth was something that we had just bought after following the last meeting. Recall that in March, when things were kind of cratering, we had I shouldn't say that, when equities were cratering and treasuries were rallying, we took some gains in bonds and reinvested half of that in stock and kept half of the powder dry, so to speak. And then at the first quarter meeting, we had made a recommendation or at the first quarter review during the second quarter, we had made a recommendation to reinvest the remainder of that cash with an overweight towards domestic, in particular domestic large growth. And so that's when we put in the Fidelity large growth index. It's giving you it's basically a way to tactically overweight growth within your large cap exposure. Because if you have the S&P 500, you just sort of own everything, whereas the Fidelity is focused more on the growth names. Okay, so I think big picture, not that we're trying to pat ourselves on the back here, but it is I think the tactical shifts that were made in March and then again in June, you can see have borne some fruit. And sure, it's as the old saying goes, it's better to be lucky than good, and we had some very fortunate timing with those decisions. But that being said, it really gets to the concept that Claire touched on earlier is, it's not just what your return is, it's what you return in up markets and arguably more importantly, what you keep in down markets. And although we left a little bit on the table, and you'll see this for the town and the police as well, we left a little bit on the table during the recovery. That more conservative stance, when we look at year-to-date numbers and 1 year numbers, et cetera, has added excess return.
So I'll just touch very briefly on, as we move down to the first of our active funds, we have Transamerica and Lazard. These are international managers. Transamerica is value-oriented. Lazard is more growth-oriented. We see Transamerica actually outperforming the value index across the time frame. Lazard, as I said, they used to have a notable growth slant. In the fourth quarter of last year, they looked at the markets and said, there are some great companies that are undervalued. And they sort of did this a rotation towards more sort of down the value curve, if you like. And the timing at the end of the fourth quarter and into the first quarter actually didn't work out so well. But however, those purchases they made did bear fruit in the second quarter, and they showed notable outperformance. They were up 16% in the second quarter. But they're showing a little bit of outperformance just on that, the year-to-date number. And then mixed results they had back in 2016 with the dark days of Brexit, which is dark still. They made some position changes sort of ahead of the market swoop. It didn't work out so well, and then they missed out when the markets turned around. So we were patient with them at that point. We stuck with them. The returns sort of turned around very strongly in 2017 and 2018. So when we're seeing this mixed results over the longer term, I would take them with a grain of salt. We've worked with Lazard for a long time, and obviously the underperformance is pretty slight here. And overall, they've done a solid job. If we turn the page, Michael, move into international territory. Oppenheimer Developing Markets is our emerging markets manager. They take a different stance than a lot of their peers, who they're not so commodity oriented. They look at the consumer. So one of the trends they've had for a while has been e-commerce, which, as we know, has been very beneficial, and healthcare. They're looking at the aging demographics and seeing so much potential there. But also don't like state-owned companies. So a few years ago, they had some underperformance because at that point, China was sort of racing ahead in the markets, but a lot of that was state-owned entities, which they just didn't want to be involved in. Same as Russia. They used to be very underweight in Russia, but actually this year, they've made several acquisitions, and now they have a 9% position, which is slightly overweight the market. They're also different to a lot of their peers in that they have a very light allocation to South Korea and Taiwan, because they believe these to be developed markets. So where that's a heavy component of the emerging market index, they're very light there. But their stance bears fruit because actually they're ahead of the index of the peer group across all time frames. Cohen & Steers, we're into real estate territory. Obviously, that's had a lot of news lines recently. This number, I think we had this about the same time last year. The 11.24% return is correct in that it matches what we have in the statement. However, they had a capital gain and dividend distribution right at the end of June. And because it was on the last day of June, it hadn't settled, so it doesn't show up in our second quarter return. So the fund was actually up 13.9%. And we're not getting the benefit of that uptick, so we will see it in July. So we'll see a greatly enhanced number in July. So when we see this underperformance over the 3 months and year to date, it actually is ahead. I've had several conference calls with Cohen & Steers because obviously real estate has been a big topic of conversation. One of their areas actually that they had gains in is surprising. They actually, in some of their regional hotels, were one of their strongest contributors in the second quarter. As we've heard, a lot of people have been leaving the urban areas because COVID has had such a larger impact, and they're trying to move out to less dense areas. And so, especially recently, there's been a notable uptick in these regional long stay hotels where people are returning to sort of getting out and going somewhere different. And so that has been an area of increase. At this point, I thought this probably a few weeks ago, but they were saying that the rental income, the rent is still about 90% of the norm. So we haven't seen the drastic downturn that was expected. Now, it still may come in certain areas. There definitely will be more impact, as some companies we're already beginning to hear are pushing working from home and not going back to the big offices. However, this is an area that Cohen & Steers is lighter on. They lightened up notably on their hotels, travel and leisure, as well as the office space. They think at that point it probably will come back, but it's not an area they want to focus on right now. They definitely have had more focus on the cell towers, on the data storage, or self-storage, the data centers, which obviously, these big tech companies, they need places to store and keep cool and have a good electricity supply to all that, the big computers. So that those areas have done very well. Self-storage actually was one of the few areas where they had a little bit of a a detraction because there was a surplus in supply because everyone rushed out to provide these areas. So there's a bit of a glut right now. But if all the students are now returning back from the universities where they went, then those storage units might be getting filled up again. So I think this is one of the reasons we've switched from a passive manager to an active manager, because obviously the index is stuck with its underlying securities, and Cohen and Steers have really navigated well through up and down markets. And then we move on to fixed income. BlackRock is our high yield manager. Part of the reason they underperformed in the second quarter was they're underweight in energy. Now, energy got decimated in the first quarter. The price of oil plummeted. There was just a glut. There was nowhere to store it, so we actually saw negative prices coming through. In the second quarter, it was the sky was not falling. The world was going to continue. There was sort of this probably over exuberance. The price of oil bounced back up again, and so that underweight hurt BlackRock at that time. Obviously, energy is going to continue to be a volatile area moving forward. And Voya is our fixed income manager. For this portfolio, they take a somewhat more conservative stance. However, they did take that dislocation in the first quarter and they bought up some corporate securities. As with the equity market, obviously the corporate securities got oversold. So they took this as a good time. They sold off some of their treasuries and bought into those corporates. They now have a slight overweight. And we're seeing their returns, ahead of their benchmark in our 12-month time frame. But not by a huge amount, but in fixed income, you don't tend to. And they are a more conservative stance in this portfolio. So it's good to see we have that outperformance now. Nearly a third of our portfolio is there.
Just a quick comment on that. You've heard this before, but I think it bears repeating. Look at the returns from core fixed income, 7.3% for the trailing 1 year. Obviously, it's been extremely unusual times, but this again is just further evidence that one of the few things that virtually everyone in the investment universe agrees on is that you cannot predict short-term interest rate movements. And we've been kind of talking about this off and on for years now, and you think kind of tongue in cheek, there's still a universe of people out there that are, sitting in cash waiting for CD yields to come back up. But, the problem is they've been doing that since 2008. And when yields have only come down. So I think it's, it really just is, it just drives home the point, because there can be time periods when you scratch your head and say, what do we have all these high quality bonds for? But it's for exactly times like this, the kind of the unforeseen rogue waves, if you will, that where they really show their value.
Okay.
So which plan we would like to go to next?
I'm sorry, Claire, you broke up there for a second.
So, any questions on the Fireman's Benefit Plan, or would you like to move on to the?
Well, I think at this point, on the agenda, we talked about, we have the consideration of rebalancing, as Michael mentioned.
Yep.
Are we at that point?
Yes.
Okay, so let's do that. And if you could state clearly what the recommendation is, and then I'll ask for a motion.
Sure. For the Town of Madison Fireman's Benefit Plan, we recommend rebalancing the portfolio back to policy as illustrated in the spreadsheet, which you should all see on your screen right now. The net result of which is taking gains from equities, reinvesting in cash and fixed income.
Okay. Well, I'll ask for a motion then.
I'd move to do that.
Okay, Paul, thank you. Is there a second?
I'll second.
Okay, that's Joe. Any discussion? Okay, since we have a quorum, 4 out of 7, let's take the vote. All in favor?
Aye.
Aye.
Aye. I think we have everybody, Joe, Paul, me, and
Bill's out there somewhere, right?
yeah, and Joe, Paul, myself, and Bill. Yeah, so we're all set.
Are any of the firemen present? Have they
Yes.
voted?
Yes,
Okay.
Bill Carroll. Okay, good. That's done.
Okay, so next we have the employee pension. You know, we can skip ahead to the police if you prefer, but whichever you have a preference.
Okay, we can do the employee. Let's just follow the agenda. The first is the approval of the minutes from the May 20 meeting. I'll ask for a motion to approve. Well, actually, I'll make the motion that we approve the
You can do
minutes of May 20th. Is there a second?
I'll second.
Joe and I will
Okay,
say.
Joe again, thank you. Any questions, any changes? Okay, all in favor?
Aye.
Aye.
I think, let me just make sure. Joe, myself, Paul. Okay, yeah, we're good. We have 3 out of 5. So, okay. Looks like that's approved. Okay, Michael or Claire, go ahead.
Great.
Go to full screen as well, we'll go to page 7, please, Mike, thank you. And can you push us to full screen, Michael?
Oh, yep, sure.
Okay, so same format as before, starting that top right-hand corner, a return of 585. So we got a nice bit of outperformance here against our benchmark, which was on 5.47, going back to October of 2006. And in achieving that return, we 6% less risk was taken. So a bit of a wider spread here. We see the beta was 0.94%. So not surprising when we look at the upside and downside, a little bit of a change here. So not fully participating on the upside capture. We see that 565 versus 595. So a goodly portion of it. But I think this is more the defensive coming through. As you see on the downside, you see a wider spread here. The downside deviation is at 8.75 versus 9.24. So pretty good upside, but more focused on protecting on the downside. And that all comes together on the alpha here. We see that larger number of 0.06. So overall, there was value added in the return ahead of expectations, given that there was outperformance that was less risk taken. So that was sort of overall, a good summary. As we look to our cash flow, we started off with $10 million way back in 2006. And as we see our net cash flow being positive, so we've seen about negative 1.6% come out of the pension plan over that time frame. But there's been notable growth to the tune of $11.6 million, again, from realized, unrealized gains, plus income and interest. But of course, you're more interested in where we are now. So since the end of June, we actually had withdrawals netting out about $137,000. When we closed as of yesterday, the market value had increased to $21,383,726. So that's a gain of $1.3 million, which, as I mentioned, it's been a good couple of months. So we're up 6.6% approximately since the end of June. I'll turn it over to Michael. Michael, do you want to just touch on the rebalancing? How you have that page up there? Or?
Sure. Actually, let me bounce back here. So we can see these are the numbers that Claire just mentioned, just $10,000 in contributions, $147,000 in withdrawals. So net outflows of $137,000, and then market gains of 1.3 million, and leading to a net growth of just under 1.2 million at 21,383. Much like the fire, we are about 3% away from our policy, although as you can see, we're about 50% low on cash. And again, we'll make this recommendation formally after the after the performance review, but we are going to be recommending rebalancing this portfolio back to target as well, replenish the cash and lock in some of those gains in the equity markets.
Thank you.
Is that everyone see that?
Yes.
So Michael mentioned our target. So our target here is 65% equities and 34% in fixed income. At the end of June, we were just 1% over in equity. So as we mentioned, it was now that we had an extra $1.3 million, that's what pushed us into being slightly heavier in the equity allocation. Again, we have about a third of the portfolio is indexed. And looking at the returns, a wee bit short for the second quarter, 13.4, although part of that is due to that misleading number on Cohen and Steers. But we got a little bit short on what was a very strong quarter. I had normally, we look at a return for the quarter of 13.4% and sort of a hallelujah moment, but the markets were incredibly strong. So, we're trailing just a wee bit on that second quarter. However, probably more importantly, when that devastating first quarter, we actually, fell noticeably less. So year to date, through June, the return is negative 3.5 versus nearly 5%. So that's where we will have to work a heck of a lot less hard to make up dollars when we didn't do it in the first place. So that's a full comfort, albeit. Our 1 year number, again, we're sort of ahead by nearly 2%. We're up 3% versus 1% index, and that outperformance continues across the longer term time frame. Obviously, we want to see this up. It's good to just see that consistent outperformance. As with all of the plans, and Michael talked about the tactical changes we made, so the Fidelity large cap focus also added here. And so we've got a very similar lineup. We can track down to that everything on this page we actually just discussed previously. So I'm not sure, but they're all the same all the way through. So it's the same lineup with the same comments that we. So I won't abuse your ears with repeating everything.
Just one quick comment. Look at the 1 year number, 3.03 versus 0.90, and this is to borrow Claire's term. This probably comes as cold comfort to you all. It's I think if we asked you at the end of March if you thought you'd have a positive return at the end of the fiscal year, most people would probably have said no. So certainly, relative to perspective, a 3% return, not only beating the benchmark, but just the fact that it's positive at all, given the circumstances, is a bit of a welcome surprise. But under the category of cold comfort, it obviously doesn't come close to hitting the actuarial assumed rate of return. So this is kind of one of these unusual years that I think all in all, I think the portfolio, given the market and economic conditions, I think the portfolio shown quite well. But unfortunately, given the market and economic conditions, still came up well short of the assumed rate of return for the trailing.
And that percentage growth right now, as of your latest, your other spreadsheet, would be what? It's.
Well, we had about a what did we say? About a 6% growth since the end of the quarter. So. It's we'd have to do the math out. It's not as simple as just adding it there, but I think realistically speaking, we've turned slightly positive on the year, but we still have that huge drag from the first quarter.
Yeah. Okay. Right.
Maybe like the one fund we didn't talk about, T. Rowe Price, is actually the one fund that's different in the lineup. It just has superior returns across all time frames. Yeah, and year to date through June, it dropped down 7%, which is pretty awful. But the benchmarks with the small cap index was down nearly 13%. This fund actually now is in positive territory. Year to date, it's up 1.3%, so it's moved into positive territory. It also did relatively well in that first quarter when the small cap market really got hit hard. the index was down 31% in the first quarter. Again, comfort. The euro price dropped 26%. So there was a 5% sort of protection compared to what the underlying index is.
One of the things that I noticed in all these, that I'm very glad that the large U.S. stocks are doing so well, because that means we're doing well, and that's what we're emphasizing now. I don't quite understand developed markets and Europe. I mean, they have contained the virus probably more successfully than we have. They've given massive support to their economies. They're doing, cross-border support, which they've never done before. And, I guess Europe has been, and developed markets have been up a little bit more lately, but I don't quite understand that underperformance there. I mean, given our weighting, it helps us, but could you talk to that just a little bit?
Yeah, that really is an excellent question, because everything you said is spot on accurate in that by all accounts, virtually everything that's been done in Europe and in much of Asia, quite frankly, for that matter, and much of the rest of the developed world, has kind of overshadowed the efforts of the U.S. Now, we can probably debate for the rest of the week as to what the cause of that is, but it's ultimately at the end of the day, it's partly, I think, just a function of our society, and we have historically just put such a tremendous emphasis on individual liberties, more so than than the Asians, and even arguably more so than the Western Europeans. And so that has, made their jobs arguably a little bit easier, and their economies have started to recover a bit more quickly. That being said, there's a few reasons why the U.S. is doing a little bit better. One is there's just been this trend for the past couple of years. I mean, these things tend to sort of ebb and flow, relative periods of outperformance and underperformance, and the U.S. has been, for the past several years, been doing quite well versus the international markets. And so consequently, kind of going into COVID, the U.S. was in a stronger position. So although, we arguably had a deeper dip and a slower recovery, we started from a stronger position. In addition to that, Europe and Asia in particular, do have these demographic issues with, the U.S. has to a lesser extent, but they have significantly aging populations, which is going to weigh on long-term growth prospects. And then, the one last thing is quite frankly the technology. For all the talk about how the rest of the world is sort of catching up to the U.S., one place that we are still clearing away ahead of the rest of the world is technology, and anything touching technology has, for the most part, held up quite well, if not flourished during COVID. So I think you put all that together, and that's why the U.S. has performed a little bit better. Now, with that as the backdrop, however, we are, by historic standards, at a point at which we're getting a little, shall we say, an unusual territory with the relative outperformance of the U.S. versus non-U.S. Similarly, we're getting, it's kind of an unusual, the relative outperformance we've had from growth versus value. But that being said, just because something is, kind of offline with historic norms doesn't mean that it can't persist. When we're starting to look at this, our investment committee is starting to, consider at what point should we start to pare back our relative U.S. overweight, but we don't think it's time to do so yet. I did just bring up, just if you'll indulge me for another 30 seconds, I did just bring up those statistics, and I think they're meaningful when you look at the economic recovery as well as why the U.S. is held up as well. The state of Massachusetts did a survey this spring and determined or came to the result that 88% of individuals with an advanced degree have the ability to work from home. Contrast that with 35% of individuals with a high school degree or less have the ability to work from home. 75% of those making $150,000 or more have the ability to work from home versus less than half of those making under $50,000 a year. And when you compare hourly workers to salaried workers, again, about 3/4 of salary workers are able to work from home versus about 40% of hourly workers. So, all of this stuff is all kind of intertwined as far as the recovery we're going to see. But that's part of the reason I think that the U.S. has held up as well as it has, or at least the markets have, because we started in a relatively stronger place, and in a lot of ways, our technology and what have you is kind of kept us there.
Okay,
Great. So just coming full circle to back to the rebalance. You can essentially frame the recommendation the same way we did for the fire, that we recommend rebalancing back to policy to replenish the cash, as well as lock in some of the gains that we've seen from the equity markets. And that's illustrated on your screen right now.
okay, thank you. So that is the motion. That's not the motion. That's what we're going to be voting on. Do I hear a motion? Okay, Paul, you raised your hand. Thank you. Is there a second?
I'll second it.
Joe seconded it again. Okay, any discussion? All in favor? Aye.
Aye.
Okay, everyone's in favor, so that that motion passes, and Cheryl's going to note that. Okay, great. Thank you.
Okay.
Let's go to police.
On the home stretch.
Pardon?
We're on the home stretch.
Yes, we're on the home stretch. The first thing on the police agenda is that we want to approve the minutes of the May 20th meeting. I'll make that motion that we approve. Is there a second?
I will second.
Paul seconds. Any discussion or changes? Hearing none, all in favor, say aye or raise your hand.
Aye.
Aye.
Aye, aye. Okay, good. So that is approved. Okay,
Good.
Claire.
So,
One of the great things about virtual meetings is the thousands of trees that have been saved.
that's for sure.
Although the timber industry haven't definitely been doing very well, because for love nor money you can't get treated wood these days, because everybody's been out making porches and built-in screens and
Unless you want green lumber, you can get that from all the trees that came down,
Yeah, that's for
at
sure.
least in this state. Okay.
we dodged that bullet down in Maryland. Okay, so the same routine here. So we're looking back to 2007. Our return since inception, 6.8%. So we have a nice spread.
Claire, I don't know. Everyone else I can hear fine, but you seem to be muffled at times. Is anyone else having that problem?
Yes.
No, this is my large laptop died, and I just got it back yesterday, so I'm on my travel laptop, and I think it probably doesn't have such a as my larger one. So this afternoon I'm going to be up and running, so I apologize if this is.
If it's easier for everyone to hear, I'd be happy to review the performance.
I trust you with it. Take it away.
Okay, I didn't quite hear that, but let's, so on page 7, this is going to be a very similar report to what you've heard for the town and the fire. But again, a similar theme. If we look at the maximum return and the minimum return, we're generally leaving something on the table when the market's running, but providing downside protection. and that has, on balance, led to aggregate outperformance. You can see going back to 2005, a 6.8% annualized return versus 6.06 for the policy. The power of compounding, if you will, what seems like a fairly small excess return when you compound it over multiple years, you can see in terms of total return, that translates to almost 30% more total return at 177% versus 149%. And that has come with about 4% less volatility. So all in all, continues to be a good experience for the police pension. You've gotten a return above and beyond the benchmark with slightly less volatility than that of the benchmark. That translates to a positive alpha. This one actually has the highest alpha at 0.08. And in dollars and cents, at the bottom right, going back to inception, we started in 1/1/05 with about $8.75 million. There's been about $8.2 million in net outflows since that time, and $13 million in earnings, bringing us to about $13.6 million as of the end of June. I think it's kind of interesting that not quite, but probably in the next quarter or two, the net outflows are going to be equal to or greater than the beginning market value of 1/1/05. And it's really the investment earnings that have provided, sort of the body that of assets in the pension. And it's kind of an interesting point because even though it may sometimes be tempting to say, why do we deal with market volatility and the like? If you weren't getting a return, you can see what the value of the pension would be, today versus the value at inception of 05. So with that, moving back to the performance page, we've discussed many of these, but there's a little bit different lineup in the police pension. Similar theme, however, a little bit of underperformance for the quarter, although excess performance over longer time periods. We're at 13.1% for the quarter, about 20 basis points behind the benchmark. For the trailing 1 year, we managed to eke out a positive return at 2.38%. Again, looks very strong relative to the benchmark, and given all the overall global conditions, I think we're all probably pleased to see a positive return at all. But that being said, obviously not keeping up with the assumed rate of return for the trailing 1 year. All in all, your investment managers performed well. Davis, which is a large cap value manager that you've had in place for a long time, and they've had their ups and downs over the years, but you can see they really did a great job with downside protection. Their trailing 1 year number is actually slightly positive, which in the large cap value space is no small feat, given the market conditions over the past year or so. Moving on to other funds, I'll just focus on what's different from the other two plans. BlackRock Midcap Growth has shown quite well, although you've had them in there for less than a year. You can see they recovered close to 30%, and in year to date, up nicely versus the benchmark, and consistent with slightly behind the benchmark to inception. Ernest Partners, small and mid cap, continues to show well across all time periods. Again, doing a great job with downside protection. That 3-year number in particular is kind of jumps out at you. With a nice positive number versus the small and mid cap index, which has just been clobbered. We also have Ernest in the small cap space. You've had them going all the way back to February of 05, and they really have been a kind of a star performer of this portfolio for 15 years now. And the numbers kind of speak for themselves. They've really held up in both up markets and in down markets. The other investments on this page, Claire has already touched on. And then the only thing that's different is we have a different real estate investment. You have the Invesco separately managed account. Again, this is kind of a legacy product. It's been in there all the way back to 05. And I think one thing that's worth noting here is look at that return since 2005. 7.5%. Not only a percentage point ahead of its benchmark, but when you think about the volatility we've seen in real estate in that 15-year period, whether it be 2008, whether it be 2020 or what have you, and still coming through all of this, it's had a 7.5% average return while paying a decent level of dividends and interest. It just goes to show why, although any one of these asset classes in the short run can give us a fair amount of indigestion, but it's really focused on the long-term viability and contribution it can make to the overall portfolio. So where we are today is, you can see contributions 23,000, withdrawals of 130,000, and then earnings of about 840,000, bringing us to 14,328,000 as of last night's close. We are also going to recommend a similar rebalance. Same theme as the other portfolios. We're recommending taking gains in equities, rebalancing back to target, which would entail placing about $200,000 or so, maybe just under $200,000 in fixed income, a little bit in real estate, and replenishing the cash for future benefit payments.
Okay, thank you very much. Is there a motion to approve that recommendation?
I make a motion to rebalance the portfolio.
Is that Al?
Indeed it is. You're doing a great job. Keep going.
Okay, beautiful. Okay, we have a motion by Al Goldberg. Is there a second?
I'll second.
Okay, Paul seconds. Any discussion? All in favor? Raise your hand or say aye.
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 Aye. Okay, motion is approved. Thank you. Now, one thing, Al, that we're done pretty much. The only thing is that during the course of the different committee meetings, there were no annual items, I believe. I just want to confirm that. Secondly, I didn't ask for new business. Is there any new business for any of the three funds? Three committees, okay, there is none. And I then did not ask for an adjournment of any of the committees.
Excuse me, Joe, or Jim, excuse me.
Rochelle,
No, this is Fillmore.
yeah, I know.
Okay. Yeah, please don't confuse me with Al. I have a general question that speaks to all three, and maybe this is not the venue with Michael. This might be more with the actuaries, but last quarter there was some discussion of lowering the target, the actuarial target from 7% down to 6.75% and a couple of 1/8% steps. And as I vaguely recall, there was a sort of a statement that, well, we would wait until we have absorbed the excuse me, the effect of the increased longevity of the people who are receiving the pensions. I wondered if is that still the general thought, and that whereas the moving to 6.75 might be a good thing, we're not going to do that for another year or so. Is that?
I think
That's a question. I guess you asked Michael for his on it, and then I would ask Al for his views as well.
Yeah, I mean, Fillmore, I would, respectfully defer that to the committee. I mean, if I were king for a day and had, bottomless access to funds, then, in a perfect world, we would adopt the new mortality tables and move to the 6.75, kind of in one fell swoop. But, we realize that there's economic considerations as well. So that, I kind of defer the question right back to you, because it's really going to be the town economics that drive the, you know, the speed with which that change would be made.
Well, let me do a slight rephrasing, which will throw it back at you.
Okay.
How unreasonable is the 7%?
I don't think it's unreasonable. And in fact, if I can, you know, kind of commandeer the meeting for just a moment, there was one other additional item that that we did have to present. It's the annual overview of pensions. And although we didn't distribute it with the meeting materials, but I do have it to share with you, and I'll send it on to you. If I can bring up that screen, I think it'll address some of your questions. So just bear with me one moment, please.
Fillmore, I'm going to jump in here. My memory is correct. In the past, we have looked to the actuary's report to trigger a discussion about whether we have the correct target for annualized rate of return. And I don't think the actuary has signaled anything yet. Am I correct in that? I'm trying to remember the last actuary's report. So Fillmore, while this discussion could grow out of the Board of Selectmen meeting or Board of Finance meeting or the actuarial report, maybe it should be on the agenda for this upcoming budget cycle. I don't see any reason that we shouldn't advance it. I don't think we as a committee necessarily, in the past, we have made recommendations regarding this, but I don't think either the selectmen or the Board of Finance members necessarily have to wait for us to trigger a discussion like this. Is that your memory, Fillmore?
Yeah, I don't disagree with that, except that this is a very learned group, and we would appreciate their input. But as Michael, as I look at this page that you have up there, the funding levels down at the bottom there are, I think, maybe a tad better than they were as I scribbled down a month ago.
This came from the most recent actuarial report ending June 2019.
Okay. Okay. Well, again, I must have scribbled wrong, because these are the police in the town look better there than what I had scribbled down. So, okay. So is this when did this particular document that we're looking at come out? Did you just do this, or?
We just did this, and this is, you know,
okay.
hot off the presses, shall we say. But what we have here really is, and what we've done here is Hooker and Holcomb does a survey, and, you know, they, fortunately for the rest of us, they have folks on their staff that kind of sift through all the CAFRs of the towns in Connecticut and compile some statistics. So we borrowed heavily from that, as well as the CAFR of Madison. But I think the top half of this page, you know, and really the first paragraph gets to the heart of the question. And that is, you know, around the state last year, assumed rates of return declined by 7 basis points to, on average, about 6.74. They declined by about 40 basis points over the past 4 years. So, you know, at 7 and 6 3/4, you're right in the, you know, kind of consistent with a lot of your peers. Assumed rates of return have continued to come down, and that will likely happen again next year, just because of bond yields continue to come down. I think the 7% right now is defensible, especially considering that we have been able to use rebalancing and active strategies and been able to demonstrate, you know, some excess return over time. But, you know, the trend should certainly be to get a plan in place to continue to move that down a little bit. Next couple pages. This page is kind of interesting, I think, because this gets to the money weighted rates of return, which GASB requires you to report. And money weighted, these are going to be different than what you see in the performance reports, because money weighted rates of return take into account the timing of cash flows, essentially. And it's kind of interesting. You can see there was some fortunate timing for cash flows with the town plan. Their money weighted rate of return, even though their time weighted rate of return was essentially, substantially similar to the other plans. The money weighted rate of return, really helped. And that's just a function of fortunate timing of cash flows. Next couple points here, you can see you're definitely ahead of the curve, having adopted the new mortality tables. Only about 1% of plans in Connecticut has done so. So that is definitely, as I said, you're a bit ahead of the curve on that. And then, a little bit about OPEB. I don't believe Madison's funding its OPEB liabilities currently, but, we are getting to the point where more and more municipalities are at least starting to fund OPEB. You can see only about 55% of plans are unfunded. And that number is slowly declined. That number, looked at it 8 or 10 years ago, and that number was closer to 90%. Although we have started to see, a couple of OPEB plans, although there's only 2 of them in Connecticut that are fully funded, we have started to see a couple of them become well enough funded so that they're starting to actually pay current liabilities out of OPEB trust. So, and that's something that the rating agencies are starting to take a look at. So that, again, this is obviously another expense in addition to, or separate and apart from reducing the assumed rate of return. But you may, since you've already adopted the new mortality tables, and you've taken steps in the right direction for your assumed rate of return, it may be worth giving some consideration to, and as well as having, maybe a discussion with the rating agencies or your bond counsel as to if there is more money that's going to be devoted to employee retirement benefits. Do they view it as kind of better from a credit rating standpoint to reduce the assumed rate of return to 6 3/4 on the pension, or possibly start to fund the OPEB liabilities?
Yeah, our OPEB, Al, correct me if I'm misremembering here, but we pay, OPEB is basically medical expense for retirees, and we pay all of that out of pocket, just like our current employees. So,
correct, and that's what most municipalities do. However, there were changes to the GASB rules a number of years ago that required municipalities to note the OPEB liability, and that eventually evolved, and now more and more are starting to fund that OPEB liability. Yes, most are paying current expenses on a pay-as-you-go basis, but we're starting to see more and more, and about half the municipalities in Connecticut are pre-funding future liabilities. And again, that's something that's, GASB requires reporting on it, and that's something that the rating agencies are also looking at. So it's ultimately whether or not you decide it's appropriate for Madison, obviously that's, many steps down the road, but it is a conversation that's probably worth considering.
okay.
I think to start this discussion, I'm following up, Fillmore, on your question. I think we should specifically ask our actuary to make a recommendation to us at our next meeting as to where we should be setting our assumed rate of return. And I think we can use that document in that discussion then to see if we want to make a recommendation to the Board of Selectmen and Board of Finance.
Okay. All right. Jim, sorry to have hijacked your meeting there, but I just wanted to.
I know that's a good
memory.
That's a good question. So were there any other items that we've missed here on the agenda? It's not? Okay, good. So Al, I can turn the meeting back over to you as, since we're done, we can ask for a vote to adjourn.
Well, Jim, you've done a wonderful job. I appreciate it. I was called to a Board of Selectmen emergency meeting this morning, so I'm sorry I missed some of this discussion.
Okay, well, the good news is we did have a quorum for all of our committees. So
Excellent.
minutes, we had a good review by Claire and Michael of the performance. The good news is since the end of June, we're up substantially in all of our funds. And we did vote on rebalancing the portfolios back. So I think you were here on the last one for that. So anyway.
Well, Jim, not only does the portfolio do well when you're running a meeting, but you also get us done much earlier. I salute you.
Well, I don't know that that was me, but anyway, well, thank you.
Well, Michael, you'll be forwarding us this last document you presented to us.
Yes.
Yeah, that's juicy. Unless there's any other business, let's entertain a motion to adjourn.
Well, I have a question before we.
Oh, certainly, Joe.
Claire alluded to saving trees. My question is, how are all the data we reviewed today, is that accessible to us?
Yeah, we had
Cheryl sent it out.
the performance reports, I believe Cheryl sent out. I'll forward to Cheryl this piece, which you do not have. And I will also forward the rebalancing spreadsheets to Cheryl, which you do not have. The performance report you should have. If you need another copy or it didn't work, just let me know and I'll resend that as well.
And the other thing that we didn't have is the one that shows the current status.
I will send those with this.
Okay. All right, good.
Any other questions? If not, let's adjourn. All in favor of adjourning, please say aye.
Aye.
Excellent. Excellent. Thank you, everybody.